So I don't really read these ahead of time. I just like to, open it up as I'm reading it, go through it, and just give my opinion on these articles because why not, right? I mean, I'm going to be reading them anyways. I might as well talk about them, and maybe there's a bit of discussion to be had. Big six profit margins to enjoy boost from fixed rate mortgage increases. Canadian banks' profit margins will likely benefit from an earlier than expected increase in fixed mortgage rates, but some observers are warning that steady growth in rates could blunt demand for loans. Disturbances in fixed rate products are noteworthy as they comprise approximately two-thirds of Canadian mortgages, which is very interesting. When you take a look at the numbers, the rationale for fixed rate mortgages doesn't really make sense. Most people end up breaking their mortgage early, which leads to a severe penalty for breaking your mortgage. A lot of people are attracted to the 5-year fixed. You break your mortgage, then you have to pay the interest rate differential, which is basically a calculation used to determine what is owed to the bank for you ending your contract early. And the longer the term of the contract, the more the penalty is going to be. So if the average Canadian breaks their mortgage, just say after 38 months, which is more or less the case, then why are you getting a 5-year fixed mortgage? Wouldn't it make more sense to at least get a 3-year fixed mortgage, or a variable rate mortgage where the penalty is 3 months interest? So it's just really interesting how most of it's marketing, most of it's pushing a particular product. Mortgage agents, brokers, the bank lending reps. A lot of the time, the lenders are paying more commission for a longer term product, right? So there's incentive around purchasing a longer term product, or I should say, there's this incentive around selling a longer term product. Now, whether or not it benefits you is another story. You really have to do some planning around your mortgage. I mean, it's very simple just to look at the interest rate and say, I want a lower interest rate. Where usually what the question is, or usually what you should be wondering is, how can you save the most money over the term of the mortgage? That's the question. And you do that by looking at your lifestyle, looking at the likelihood of you breaking the mortgage early, looking at the trajectory of interest rates, looking at the likelihood of you staying in that property. Maybe you move into a new property. Or what's the likelihood of you wanting to do repairs or take out equity in the future? What's the likelihood of you doing a lot of these different activities? Now, obviously, we don't know what the future holds, right? But we should be trying to do a little bit of planning to minimize the potential risks of paying additional penalties and higher rates than we may have to. So sometimes it makes sense to have a 5-year fixed mortgage. A lot of times it's less expensive to have a variable rate mortgage. Sometimes it just makes sense to do one thing over another, depending on the situation, depending on what you're looking for. And it just don't be as simple minded as saying, well, it's a lower rate, so it must be better. It's a 5-year fixed, so it must be better. Just because that's what the bank wants to sell you doesn't mean it's for your best interest, right? Anyways, just going on there, just because you're seeing here that we're saying that increase in fixed rates are going to be leading to increased profits, and it's like, well, those profits come from somewhere, right? I mean, it's a transfer of value from your pocket to theirs. So the fact that yields are moving up is a double-edged sword. said Sadiq Adassia, Chief Investment Officer at Sun Life Global Investments. It generally means there's a light at the end of the tunnel. Adassia, who initially projected these increases to take place closer to mid 2021, added that significant movement in rates stemming from upward trends of yields will put pressure on the mortgage growth while raising funding costs. Should residential loan demand shrink due to rate growth while other mortgage products remain languid, the Big Six might face significant earnings risk, says James Shanahan, equity analyst at Edward Jones. However, with the largest U.S. banks exhibiting lower loan losses and smaller provisions for credit losses, Canadian banks that deal south of the border might enjoy generous elbow room when it comes to risk. The Bank of Montreal, in particular, is uniquely positioned to reap such benefits, according to Mike Rizvanovic of Credit Suisse. This is largely because of the bank's accelerated lending to US based businesses prior to the pandemic, along with its large commercial lending business in the Midwest. That's pretty cool. Having our banks diversified out, just well, I mean, into the U.S. That's important because we want to make sure our banks are as long as they're keeping to the same habits that have allowed them to weather many of the financial storms that have taken out other banks in other places. Um, a lot of it had to do with their having tighter lending guidelines, just doing the underwriting properly. I mean, banking is a very old tradition. It's a very old business, and they really know at this point. They know how it works. They know what a good loan looks like. Right? They know how to make money off of this, and this is why they steadily produce earnings growth year over year for the longest time. So that being said, I'm going to bring the video to a close. It's really not much. It's just letting you know that rates are on the rise, and this may be a benefit to the banks. And also, just again, when it comes to your mortgage, just ask more questions about what's best for you. Just to me, it's kind of depressing seeing how the 5 year fix is still the most popular product on the market, considering most people are not. It's like buying a suit that's two sizes too big and hoping you're going to grow into it, knowing that you're already a full size person. You're not getting any bigger. Why are you buying a suit that's ill fitting? It's just not appropriate. Get something that's better suited for you. I mean, the rate may be it might be a couple points different, but what would you rather do? Would you rather spend potentially tens of thousands of dollars in penalties, or maybe a few $1,000s or less than that in interest rate difference? Again, it's just a matter of having a clear idea. Excuse me, having a clear idea of what it is you're looking to do with your property once you've purchased it. All right, so that's everything from me. Let me know what your thoughts are. I mean, what product do you have? Are you just looking for the lowest rate? You're going to stay in the home for forever and a day, and all you need is the lowest rate. You're never planning on refinancing or doing anything like that. It's just straight paying off the mortgage, and you just want the lowest rate every single time. Or do you think flexibility is something that would be important to you? Are you planning on selling the home down the road? Let me know what you think. Your thoughts are. All right. Have yourself a good rest of your day. Cheers.